Hi, Karen Bangs here from Cal Poly's Industrial Manufacturing Engineering Department, and we have the first of 3 examples around MACRS, or Modified Accelerated Cost Recovery System, depreciation. You've learned a little bit about what depreciation is, why companies use it earlier in this module. Now we'll go through some examples. Let's read the problem statement for the first one. A computer was purchased for $20,000 and $2,000 was spent on installing it. The computer has an estimated salvage value of $4,000 at the end of its useful life, which is expected to be 10 years. Sorry about the misspelling of useful. Compute the depreciation deduction in year 3 and the book value at the end of year 6 using MACRS, Modified Accelerated Cost Recovery System, General Depreciation System. So we have some information down here. We see the market value. What we can buy it for right now is $20,000. We have the installation cost is $2,000. And remember, what we've learned earlier is that we're going to capitalize, or we're going to depreciate the total cost to put the equipment or the asset in service. So even if we buy the computers for $20,000, if we don't spend the $2,000 to install them, we won't be able to use them. So the full $22,000 is what we're going to capitalize, or is what we're going to depreciate over time using MACRS. It has a salvage value at the end of 10 years of $4,000, and it has a useful life of 10 years, as information given in the problem above. It's also telling us in the problem above that we want to use MACRS to determine our depreciation schedule, how much depreciation expense we're going to take to the income statement each year, how much we're going to reduce the book value by each year, is another way of saying that. So with the computer, we know with MACRS that we don't use the useful life. We use whatever property class a computer falls under. So let's go look at the table to the side here. And we know that these are available in any engineering economics book. You can also pull these up on the internet. These are published by the Internal Revenue Service, who developed MACRS for depreciation purposes. So if we read through the 3-year property, we see there's nothing there about computers. But if we read through the 5-year property, we can see that computers are listed, computers and peripheral equipment are listed as a 5-year property life, 5-year property. So that means that we use whatever the MACRS depreciation rates are per period for a 5-year property in order to depreciate this computer over time. So if we look down here, we can see that the recovery rate from the tables are 20%, 32%, 19%. Those are also shown to the side here, and again also available in any engineering economics textbook, and you can pull up online or through the Internal Revenue Service page. And we know that each column represents the property class, and so we just identified earlier that the computer falls under the 5-year property class. And then each row represents the percent of depreciation that we are allowed to take during that year. So for a 5-year property, we're allowed to take 20% of the cost basis, in our example, $22,000, 20% of the cost basis in year 1, 32% of that cost basis in year 2, 19.2% of the cost basis in year 3, 11.52% of the cost basis in year 4, etc. What you'll notice too is that for whether we're looking at the 3-year property class, the 5-year property class, the 7-year property class, etc., the sum of the percentages adds up to 100%, because by the end of the property class life, we want to have fully depreciated, aka written the book value down to 0, also meaning that we have taken depreciation, all of the value of the assets to the income statement via depreciation expense each year here. We also can recognize the half-year convention here that we learned about earlier in this module. Now, we know that for 3, 5, 7, and 10 year we use double declining balance, and for 15 and 20 we use 150% declining balance that converts to straight line. For 3, 5, 7, and 10 year, we use 200, also known as double declining balance. It converts to straight line. And we can see this because for a 5-year property, we know the double declining rate would be 2 divided by 5, 2 divided by the number of years that we're going to depreciate it over. That would give us our rate. That's 40%. 40% divided by 2 is 20, so we're taking half of that double declining balance rate in year 1. Okay? And that would be the same if you did that calculation for 7-year, for 3-year, etc. Okay, you can also see that, and you know from prior information in this module, that MACRS, and we just said MACRS is a combination of declining balance and straight line, and so you can see when it converts over to straight line. Converts in year 4 for the 5-year, because you can see then it's the same amount each year after. In year 5 for the 7-year, in year 7 for the 10-year, etc., and then the depreciation is straight line. It converts to straight line in the year that the depreciation for straight line is higher than the depreciation for that year would be under double declining balance. Because MACRS is modified accelerated, we're trying to accelerate to depreciate as soon as possible. So that's why we move to straight line when its periodic depreciation or depreciation for the year is higher than it would be under the double declining balance calculation. It also allows us to be sure that we take it all the way to 0, the book value all the way to 0. We can also see the half-year convention again in the fact that we have a 5-year property class, but we depreciate it over 6 years. So we have half a year in year 1, plus half a year in year 6, that's 1 year, and then years 2, 3, 4, and 5 are all full years. Same thing, we have a half a year in year 1 under the 3-year, a half a year under 4, so that makes 1 year, plus 2, plus 3 full years. We just have it spread over 4 years in this case. Okay, so this is where the rates come from. These are the percentages that we multiply by our cost basis to get the depreciation in any given year. So if we go back to our problem, we can finish out our table and we see that our depreciation for year 1 is going to be 20%, our rate, times our cost basis of $22,000. We can see in year 4, our depreciation is 11.52%, so 0.1152, times the cost basis of 22. And that's how the periodic depreciation is calculated for each year. And you can see that it goes from 4,400 to 7,040, 4,240, 2,534, etc. Always the recovery rate from the depreciation table that we just looked at multiplied by the cost basis. Okay? Then we have our book value at the end of the period. So our book value at the end of period 0 is simply what our cost basis is, because that's when we purchased it and put it into service. So we put it into service at the end of year 0, beginning of year 1, and we have our remaining book value at the end of year 1 is going to be the book value at the end of year 0 minus the depreciation. So 22,000 minus 4,400 depreciation in year 1 leaves us with a remaining book value of 17,600 at the end of year 1. If we go to year 2, our ending book value is now our beginning of period book value, which was 17,600, minus the depreciation for the period, 7,040, gives us a remaining book value at the end of year 2 of 10,560. And that follows suit throughout the entire table down to year 6, which we know that we would have a book value of 0 because if we added up all of our rates, you can see they sum up to 1. So now we have taken all of the cost of the asset to the income statement via depreciation in each year as shown by these numbers, by these depreciation expenses in each year. And so our book value at the end of year 6 is 0. Well, it said that we're going to use this computer through 10 years. So what does that mean? It means that we can still keep using it, no problem whatsoever. It's just I only take the table through year 7. But we have no additional depreciation. So we're using the computer, we're getting value out of it in years 7, 8, 9, and 10, but we have no associated depreciation expense, which would increase our profit for the company. D sub K typically is identified nomenclature for the depreciation for the period. D sub K star is the accumulated depreciation. So we can see our accumulated depreciation by the end of year 1 is simply the depreciation that we incurred in year 1. Our accumulated depreciation at the end of year 2 is depreciation for year 1 plus year 2. Accumulated depreciation for the end of year 3 is simply the sum of the depreciation for years 1, 2, and 3. Okay, so that's accumulated depreciation. And one of the reasons I have this on here is because something else you can note as a checkpoint is no matter what year you choose, the book value plus the absolute of the accumulated depreciation will always equal your cost basis. No matter what year you choose, your remaining book value plus the absolute of your accumulated depreciation will equal the initial cost basis. All right, I think that is our example. We now understand how to determine which property class an asset will fall into. We find where it falls within the property class table. We then take that information to get the annual depreciation rates depending on which property class it is. And then I would strongly recommend that you build a table similar, if not exactly like this, and then you would be able to answer any question that you might get about periodic depreciation, remaining book value, or accumulated depreciation at any point in time. And actually, let's actually finish the problem. It asked us, what is the depreciation deduction in year 3? The depreciation deduction at the end of year 3 is this $4,224. Which again is our rate, recovery rate for year 3 times our cost basis. And then it also asks us what is our ending book value at the end of year 6. And we can see this from the table as well, that our ending book value is 0 after we have taken all the depreciation in years 1 through 6. Okay, so again, this table will help you answer any question that you might get about depreciation. Thanks for listening. We'll have 2 more examples following up.